Today, in this explainer, we're tearing down a highly anticipated IPO that literally stunned the market on its very first day of trading. We're looking at GoldLi Holdings Berhad. You know, when a company hits the public markets, there are certain expectations, right? But what unfolded here, well, it completely flipped the script. We're going to examine their background, pull apart the actual financial results, investigate a massive red flag buried in the prospectus, and finally figure out what retail investors should actually do next. So, imagine this. You jump into an IPO that is oversubscribed by more than 3 times. You're probably expecting a solid pop or at least a stable opening, right? Nope. Instead, you sit there and watch it plummet 15% within hours of the opening bell. That's a massive haircut for day one investors, and it immediately screams that the broader market saw something in the fine print that they absolutely hated. Okay, let's look at the cold, hard timeline from that morning on the Bursa Malaysia ACE market. GoldLi was priced at 13 cents a share, aiming to raise a relatively modest 15.2 million ringgit. But right out of the gate, it opened weak at 12 cents. No opening pop, no excitement, just immediate selling pressure. By mid-morning, it had quickly bled down to just 11 cents. In just a few hours, poof, the company's market cap shrank from 78 million ringgit down to roughly 66 million. But let's take a step back and look at who GoldLi actually is. Because on paper at least, this 27-year-old Johor property developer looks incredibly solid. They aren't some flashy, unproven tech startup. They've been grinding it out since 1999, focusing on secondary townships like Muar, Tungkok, and Batu Bahat. It's a real business with a long track record in a very tangible brick-and-mortar sector. Seriously, when you read their initial summary, they check a lot of the right boxes. They build affordable landed homes, they boast a massive gross development value pipeline of over 854 million ringgit, and they've got real experience. Plus, they use an in-house construction model, which usually means great cost control. They have a genuinely profitable track record. So, with all those solid fundamentals sitting right there, why on earth did the market reject them so decisively? That brings us to part 1. The financial reality, beyond the surface. To uncover the mystery behind that 15% drop, we've got to pivot away from the marketing and look at their actual books. And wow, the first thing that just jumps right off the page is this surprisingly weak fourth quarter result. Right before going public, they reported an unaudited Q4 profit after tax of a mere 776,000 ringgit. Look, when you're trying to dazzle the market for an IPO, stumbling right at the finish line of your fiscal year is literally the last thing you want to do. Just look at the stark contrast here. You've got a relatively strong full-year profit of 9.5 million ringgit, right next to a sudden, severe drop to under a million in Q4. It raises immediate, glaring red flags. It forces you to ask, wait, is this just a one-off blip? Or are we looking at the beginning of a structural decline in their earnings sustainability heading into the next year? And then there's the cash situation, which perfectly illustrates their underlying liquidity risk. At first glance, their cash balance sits at a dangerously thin 1.1 million ringgit. But wait, it gets worse. When you net off their 8 million ringgit in bank overdrafts, the company is effectively running on a negative cash position of 7.5 million ringgit. They are heavily reliant on bank credit just to fund daily operations. All right, let's move to part 2, the smoking gun, the pre-IPO dividend, because this is the real climax of the investigation and almost certainly the trigger for that massive institutional sell-off on listing day. Check out this comparison. Back in FY 2023, the company earned 5.64 million ringgits in net profit. Not bad, right? Well, that same year, the founding family paid themselves 18 million in dividends. Yeah, you heard that right. They essentially cleared out the vault, paying out more than 3 times their annual earnings in a single year, aggressively drawing down on the company's accumulated reserves. So the crucial point here is the sequence of events. And man, it creates a totally rational trust deficit. Over 3 years, the founders drained 24 million ringgit in cash out of the business. Then they turn around and ask the public to refill it by raising 15.2 million ringgit through an IPO. And the cherry on top, they make absolutely no commitment to pay retail investors a dividend in the future. Zero. The market saw this play out and naturally voted with its feet. So part 3, valuing GoldLi, bull case versus bear case. With all these red flags exposed and the price battered down to 11 cents, we have to ask the million-dollar question. Is this a hidden buying opportunity, or are we trying to catch a falling knife? Let's aggressively weigh both sides. First, the bull case, which is actually mathematically pretty compelling. The company's net asset value per share is roughly 20 cents. So with the stock trading at just 11 cents, you're paying a mere 55 cents for every ringgit of assets. You're buying in at a genuine, deep discount to book value. If things go right, the research actually points to an 85 to 100% upside potential. And to be fair, there are real catalysts that could drive that kind of growth. They've got a massive 322 million ringgit high-rise project sitting in the pipeline. If they can successfully launch that, and if their profit margins recover, this tiny 66 million ringgit company could see a massive re-rating. Plus, they're perfectly positioned to benefit from the broader economic tailwinds of the Johor Special Economic Zone. But let's flip the coin and see how the bear case builds up. What if that weak Q4 earnings report wasn't just a hiccup? If it's a trend and Q1 earnings stay weak, this stock could easily slide even further. Analysts are projecting a potential 31 to 46% downside risk from where it sits right now. You simply can't ignore the realities of an illiquid Ace Market stock. The founder still controls 73% of the shares, which means minority investors have virtually zero say in how things are run. Coupled that massive insider control with structural margin compression and a balance sheet basically propped up by bank credit, and you've got a classic recipe for stagnation. Okay, so after digesting the good, the bad, and the very ugly, we arrive at the most important question of this explainer. What should a retail investor actually do with GoldLi right now? Based on the research, our verdict is a nuanced, neutral to speculative buy. Because of that dirt-cheap valuation, it might offer short-term traders a quick sentiment bounce. It's a play, for sure. But if you're a long-term investor hunting for steady growth or reliable dividend income, you should probably steer clear for now and wait for some more concrete data. I want to leave you with this final thought before you make any moves in the market. Cheap is not the same as going up. A stock can stay undervalued for years if there's no catalyst. Keep your eyes locked on their upcoming Q1 earnings report to see if the business is actually recovering. But ask yourself this: when insiders show you their hand by cashing out early, are you going to fold or bet against the house?